Most individuals treat the market like a casino, either in the commodities market or the stock market. They chase after this hot red thing. Everyone's talking about it. And most recently, look at gold and silver. Everyone chase into the hype. And once a correction happens, they sell into the fear. And real wealth isn't really found in going into all this noise. It's actually found in boring, ugly businesses that nobody talks about. This is a continuation of part 2 for Malaysian Multibaggers, a book that I particularly authored. And if you want to know how you can avoid all these noises and build real wealth for yourself, stay till the end of the video. Hello everyone, my name is John, former engineer turned full-time investor, now wealth planning director at Phillip Capital, and also the author of an upcoming book called The Malaysian Multibaggers that should be out in stores March 2026. So in today's video, as a continuation of my book, The Malaysian Multibaggers, I'm going to show you the 5 successful rules of investing. Rule number 1, which is do your homework. Rule number 2, find economic moats. Rule number 3, your margin of safety. Make sure you have a margin of safety. Rule number 4, hold it for the long haul. And rule number 5, know when to sell. So rule number 1, always do your homework. Now, what do we mean? Most of the time, what's the first thing that people check whenever they are given an idea, especially a stock idea? They go and check the stock price. Now, if you think about it, what does the stock price represent? It is actually a representation of what people perceive the value of that particular stock. But underneath the stock price, what does it really represent? It represents a portion or partial ownership of a particular business. And if you ask any businessman or any entrepreneur out there, what is the most valuable thing of a business? It's actually cash flow. So rule number 1 is very simple. If you don't understand where the cash flow is coming from, then you don't actually know how to leverage on the tip that someone gave you. Now, don't get me wrong. I get a lot of stock pitches, a lot of stock ideas from any single source, right? Everybody I talk to, especially if they know what I do, and they say, hey, what do you think of this particular stock and all that kind of thing? That's a very loaded question. What do you think of this stock? Usually in the past, I would launch into my explanation of how I understand it and all that, and you see starry eyes, but what they actually want is actually an affirmation of a decision they already made, but they actually don't actually know what they bought. So now what I do is in the reverse. I ask them, okay, as a business, how do they make money? Do you think that this cash flow is sustainable and over long periods of time? Can they continue to generate any kind of recurring cash flow or any kind of recurring revenue that generates cash flow? So these are things that I think as an investor, you have to change that mindset, because the price is a reflection of a lot of things, especially emotion in the market, whether it's fear, whether it's euphoria, but behind all of this is actually a business. So rule number 1, understand cash flow. I'm going to give you an example. Everyone thinks or feels that technology is a great thing to buy into right now, which is great. But you know, instead of looking at just the Nvidias of this world, the Apples of this world, think about the ecosystem or the environment that supports the infrastructure build-up of all these AI chips or modernization of electronic components. They need to be built in factories that manufacture chips. And who makes part of the factories that manufacture this semiconductor for the electronic industry? So one player in Malaysia in particular, and I really admire the founder as well, IR Raymond, is actually Carlington Group. So if you don't know what they do, they actually engineer, I wouldn't say manufacture, engineer, construct high purity gas systems for semiconductor wafer foundries. And their clients include global players like TSMC, guys like Micron, guys like Global Foundries, Intel in Penang. And to support the AI build out today, they have to go around the world and construct these gas systems, or high purity gas, ultra high purity gas systems for these semiconductor wafer foundry facilities. So understand how they make money. It's where by this engineering build out, by constructing, by helping them manage the project. This is where cash flow is derived for the Carlington Group. So rule number 2, finding economic moats. Now, for those of you unfamiliar with this term, economic moat, it is actually a term to represent competitive business advantage that a particular business have. One good example I can share with you is anywhere around the world, if you're living in the Baltic states or somewhere in Southeast Asia, think of the electrical utility provider that supplies electricity or water to you. The moment they get a license to operate and a license to provide these services for you, they have to put in a lot of money in terms of capital expenditure to build all this infrastructure to serve water, electricity, or even fiber optic cables for your internet connection. Now, the moment that utility is in, you're very, very unlikely to change it out for many reasons. One is I don't think the government would allow a new competitor or new entrant to come in, because it has to safeguard these particular players from the upfront cost that they have to lay all this infrastructure. So there's already a regulation protection. Two, as a user, if your service is good, you get served water or electricity or internet connection that is reliable, why would you want to change it? That's a very clear example of an economic moat for a particular business. Rule number 3, always buy with a margin of safety. Now, what do I mean by margin of safety? Very simple. It's Chinese New Year, coming to Chinese New Year. Everyone wants to buy something, but we are always on the lookout for a discount. So in the stock market and in the equities market, you should always also look for a discount. You shouldn't pay face value of a particular business or a particular stock you want to own. So how do you find this? Usually there's many ways. Obviously, you can buy it based on multiple times of valuation, which is a relative form of valuation, PE, or you can use a discounted cash flow method. You can even use a reverse discounted cash flow method. So there's many ways to value a company, and not everything needs to be accurate, because as you discover over long periods of time in investing, once you're roughly there in terms of valuation, what you really want to get is, if you think the value of the business is $1, 1 ringgit, for example, what you want to buy is you want to buy it at 50 cents on the dollar, or 30 cents on the dollar, or if you can find something 10 cents on the dollar, even better. So remember when COVID was the rage and everyone was chasing into the glove mania, people were buying glove companies at a PE of 100 times or PE of 80 times. Where was the margin of safety? You were buying 100 ringgit on the dollar rather than 10 cents on the dollar, kind of thing. So again, when the music stops, the wealth is destroyed. We buy. Ironically, we buy when it's a bargain, when markets are red, when everybody says that the stock market is bad. That's exactly when we go in. And when the markets are very euphoric, when the market is at all-time high, we actually have to practice even more prudency in valuing and selecting our stocks into our portfolio. So there you go. Rule number 3, margin of safety. Rule number 4, hold for the long haul or the long term. Now, if you remember, there's this movie called Finding Dory, and Dory is known as the fish that has a very short-term memory span. And in the stock market, it is what it is today. In the past, you're talking about the 1950s and 1960s, the average holding period for a stock was anywhere between 3 to 5 years. And today, what we see, not just from retail investors, but institutional investors as well, that the holding period is anything between 3 to 6 months. Now, let me ask you, if you're an entrepreneur and you just started a business, or even if you're already started a business and you want to scale, whatever you do, right, can you change your results within 3 to 6 months? Drastically? I highly doubt it. I mean, I'm very privileged to know a lot of public listed company owners and a lot of business owners, non-listed as well, and they can tell you any initiative they want to do. If you're lucky, you get results within 6 months, and if you want it to be sustainable, the effort will likely take at least 2 years, 3 years, or even sometimes 5 years. And if you want to see businesses that have sustainable cash flow, predictable, sustainable cash flow, you're talking about 10, 15 years kind of, those utility providers. The moment you want to build a utility, it's actually a 10, 12-year kind of undertaking project for the project. That's how long that you have to be patient enough to hold for the long haul. So if you're thinking that you want to buy something today and sell it for next week, then what you're actually doing is you are buying into the market emotions or the market sentiment. You're really not buying into what I call compounding your wealth kind of philosophy. because that's where real wealth is really made. You don't want to be making 20-30% of your wealth. You want to be, when you buy a stock, it's like 10 times, 20 times, or even 30 times that particular business that you have bought into. So rule number 4, hold for the long haul. Last but not least, rule number 5, know when to sell. Yes, I know in the last point I just said hold for the long haul, right? Provided, this is the caveat, provided that the business is still growing, provided that the capital allocator or the business owner is still allocating capital to grow and scale the business in the right and sustainable manner. But if the owners of the business, the professionals managing the business are destroying value of the particular business, then you have to know how to let go. Yes, it probably was 1-2 years of holding and then it didn't seem to be working out. Then there's many other fish in the world. And that's why a lot of people don't sell is because they probably bought it at $1 and today it's at 50 cents and they said, I'll wait till it goes back to $1 and then I'll sell. But what about the time that you held on, and obviously based on your own research and your due diligence, you're finding that the company owners are not actually, they're destroying value rather than, trying to go back and scale the business. So this is where your judgment and your understanding and your know-how of the business or the stocks that you've bought is very, very important to decide when to sell, because there is a term called business decay, and you do not want to hold into a stock that has undergoing long-term either structural or organic business decay. Structural meaning the whole industry is undergoing a downtrend. There's undergoing consolidation, and only the strongest of these will survive this onslaught. It means everyone in the industry is struggling, and then you got to figure out, who are the strongest that will survive. Organic decay is like the owners of the business, and they start saying that they start doing things that go against conventional wisdom. Some may actually become a multi-bagger, but most of the time when you start, it's like there's this particular company, they are very good at cultivating and planting palm oil, and then suddenly they go and plant durians, which, if you think about it, over the long term, there's a cycle in which durian prices peak and come down. And then now with the onslaught of Chinese planters planting durian in the south of China, where there's a little bit more tropical kind of weather, and the supply will increase, what will happen to demand? Even though if demand even still keeps peaking, but because of the supply surplus, what happened to prices? So these are the things that, there's many industries, many examples I can give about, business decay. But once you study a particular business, you would know, you would sense the pattern of, hey, what is this guy doing? Is he making the right decision on behalf of the company? So there you go. You must know when to sell. Rule number 5. So there you go, the 5 rules of successful stock investing. I copied shamelessly from a book produced by Pat Dorsey and his team at Morningstar, entitled the same title. Obviously, I localize it to the Malaysian context and how to apply it. I've been trying to figure out investing since 2007. Burned a lot of time and a lot of money in making my mistakes as well. You got to figure out how to read annual reports. You got to figure out how to study and understand industries. And there's 2 options that is available for you. One, you can fast track it, have someone do the research for you, or you said, this is not for me. I'm just busy focusing on my career or my business, and you just want it to be outsourced to someone. So there's 2 options for you. Link in the description below. I'll see you in the next video.